I wanted to talk to y'all first before we got into lesson two. But the fact, so let me just say it like this: I love what we do because it's so fascinating what we do as far as being able to participate in this market. And I got a call from someone in our group, and I was actually I was actually having a conversation with Barbara. I got a call from somebody in our group, and they said they had someone that was interested in trading, and they had a question, and they just didn't know how to answer the question. Could you speak with them for a minute? And yeah, I don't mind. I love talking about trading, right? So here I talked to this person, and it was a fascinating call because she was really interested in trading, but just like so many of us, we don't get involved with trading because of things that we've heard or things that we might think or assume. But her question was, uh, why why hadn't she never heard of the market that we trade? You know, so when the person was sharing with them that they learning how to trade, what they learning how to trade commodities, but she wanted to know why come how come I never heard of that before? Um, so what is that? What is trading commodities all about? And I shared with her what we do and what trades in the market. And one thing that led from me sharing with her what we do was the fact that she said, well, can I ask you, does eggs trade in the commodities? And I said, yeah, they actually do. And she said, well, the reason I'm asking that, I've I've been paying so much for my egg. I never paid this much for eggs. So I was wondering why eggs are so high, and if it does trade in in commodities, do you trade eggs? I said, no, I don't, because eggs do trade in the market, in the commodities market. But it's really a more heavily traded market in China. And if you haven't noticed, egg prices are really high. I just explained to her that I really don't follow it, keep up with it, but I can share with you what I do know. And I can tell you right now that the eggs, from a fundamental standpoint, are higher than normal because of an outbreak that occurred last year. With the birds, and there's been quite an impact on the bird industry with an outbreak that occurred, which is still kind of going on. And some of you may or may not know that eggs are traded in the futures market, right? But funny part about this conversation was that she said she really was interested in trading, but she hadn't gotten involved with trading, period, because of one thing we talk about all the time. She said she was scared of the market. And you hear me saying that all the time about people being intimidated by trading. But there's nothing to be afraid of. We just have to come and learn that there's ways to protect ourselves, and that there's a reason that the market exists. Because before we got off the call, one of the last things she said, she thought that the market really was just something that was around for people who wanted to play with their money and try to make money, you know, playing around in the market. She thought that was the purpose of why the markets exist. And I wanted to bring this point up to explain for those who don't know that that is the last reason why the market exists. The market has a very, very important factor and reason why it exists, and it's not so people can have somewhere to play with their money. The market really was came about for farmers and people who grow and produce, the crops and things and livestock, so that they would be able to hedge their crop and stuff. That's the point of why the market came about. But the most important reason that ended up being the reason for the market is that without the market, do y'all know how our life would be in shambles with the wide price swings of how much things would cost us in the store if it wasn't for the market being around to help us not just stabilize prices, but keep prices in a range where it be for affordable for the consumers and it be profitable and for the producers and the consumer. I mean, and the commercials. So it has more than one reason why the market is it, but it's not, oh, so we can have somewhere to play with our money. Without the market, y'all just don't know how life would be. So I just wanted to share that because I had that important call with this lady, and I was, I don't know, I guess I felt some way that she wanted to get involved, but she hadn't got involved because of things she didn't understand. And I know that's the situation for a lot of people, right? So just a little sidebar I wanted to share with you guys. Well, let's jump in and see what we got for lesson two. I'm gonna turn it over to Barbara. Take care of our business first, okay? Over to you.
Yes, sir. So here is our disclaimer for Futures and Commodities Trading Group. Trading and investing carries a high level of risk. You could lose some or all of your investment. Trading commodities or any other financial instrument may not be suitable for all investors. Before deciding to trade, you should carefully consider your investment objectives, level of experience, and risk appetite. We accept no liability for any losses or damages you may incur. This means that you alone are responsible for your actions in any trading or investing activities.
Thank you.
You're welcome, sir.
Well, at this time we normally go to Dr. Melville, but I don't know, y'all. He dressed in Preston. I don't know. I guess we go ahead and go to it. Dr. Melville, can you come on and bless us with your presence tonight?
I sure can. Our quiz questions for the week. We had two quiz questions. And the first one read, which of the following are rules that we follow when it comes to trading? A, don't follow the trend. B, never use a stop loss. C, don't have a plan. D, have a system. E, none of the above. F, all of the above.
Mm,
Question again is, which of the following are rules that we follow when it comes to trading? I have from Ezra, he says D, have a system. From Lucky, Lucky says have a system. Anybody think anything differently besides Ezra and Lucky that says have a system? Okay, then Ezra and Lucky win. Have a system was the answer. Very good.
mm,
Then the next question was, what is the golden rule? A, always trade with a stop loss. B, make sure you follow the rules. C, don't risk more than 10% of your account on any particular trade. D, control your emotions. E, all of the above. F, none of the above. Question again is, what is the golden rule? So I have Lorenzo saying C. I have Franklin Smith saying C. And J. King saying don't risk more than 10%, which is C. Anybody think anything differently? Okay, then C, you have it. What is the golden rule? Don't risk more than 10% of your account in any particular trade. Very good. This is exciting. And those are all the new people that came last week. So somebody was taking notes and paying attention. Very good.
yeah,
This is so good. That does my heart good.
yeah, that's
All right,
so good to see.
back to you, Mr. Wright.
All right, thank you. Let's jump in and get going, Barbara. We covered the rules last week, got our foundation in place. Now we want to jump into lesson two, which is a very important lesson, right? Because we talk about some very important things we need to learn and know about trading. There's a lot of words and terms that we hear. We don't know what they mean, but we hear them all the time. Familiar with them, but what do these words actually mean? We want to learn terminology. We want to learn lingo, and it wouldn't make sense for us to be looking at the market or watching the market and we don't know what they're talking about, right? So let's jump in and see what we have when it comes to terminology and lingo. Oh man, love this question when we get around to this question, right? We just went over this a couple of days with someone. Uh, Me and Barbara and Dr. Melvin had a chance to talk to somebody. We asked this question, but it's always amazing just to just to see how we think and how we feel. So I want to ask you all. Um, you just happen to have some money set aside, or you came into and you want to do something with it. You don't know exactly what, but you want to put this money to use or try to make this money, make some money, right? What would you do if you had the opportunity to either put the money in Starbucks or either put the money in coffee?
Can I answer that question?
Absolutely.
Hey D, this Jamal. I remember you telling me in the 2020 class to put it inside the product itself. So if it's coffee or Starbucks, it would be coffee. It would be if it would be a company or eggs, it would be eggs. I remember that from then, bro. So yeah, I'm telling you. Yeah, I remember that. All right.
All right, Jamal. Yeah, man. So Jamal said he would put his money in the coffee. Anybody else? Just it's just a question of what you would put, where you would put your money. Um, and nothing wrong with either one. We just wanna, just shoot around the question and see what we think and how we feel. Anybody willing to share with us where they would put their money?
Yeah, Lucky said coffee. He texted in the chat.
Okay. He said he said he would put his money in coffee too.
Yeah, that's
So,
Lucky.
man, don't nobody like Starbucks. I thought Starbucks was a pretty popular place. Nobody thinking Starbucks.
No, because Starbucks could fold, and yes,
But
that's that you putting your money in the company that represents the commodity. You want to go straight to the horse. Stop playing, D.
yeah, that's my choice. But everybody can choose, right? Tomorrow they can put where they want to put it, but that's my choice.
Yes, sir. Yes, sir. I'm just making a joke, bro. I
Nah,
got
man,
you.
I know,
Yes, sir.
I know.
Yes, sir. Yes, sir.
Yeah, and the thing about it, guys, is either way, you can still make money, right? With Starbucks or the coffee. I happen to choose the commodity, the product, because I know it's a necessity. There's something that's not going to go away. And Jamal made the point that, you know, Starbucks can go away. Doesn't have to be here. And when I got my money invested in a company, I'm limited to what takes place and what transpired with that company. And that's that's one of the main and big differences for me. That if I put my money in the ingredient in the product, I'm not solely depending on what happens with this particular company. You see, I just open myself up to a whole wider range when I put my money into the product, into the ingredient, not just a company. And that's how I've always felt about that. But even if you went with the company, not saying you won't still be able to make money, um, especially if you got that company stock when it was at a cheaper, much lower price, right? So It's just a question we like to throw around just to get your mind thinking and and going based on what it is that we talking about. Okay?
So Delvin, quick question.
Yeah. Uh-huh.
So, so Lucky put in a text, Starbucks
The
needs
box.
in the chat. Starbucks needs coffee, but coffee doesn't need Starbucks. You agree with that statement?
Huge, huge point. Big point. I absolutely agree with that point. Yeah, that's huge. Think about what he said, and that makes so much sense because as a coffee shop, they need coffee, right? But a question, I mean, or a comment like what Lucky said makes you really understand that the ingredient, the product, is sold everywhere, not just at Starbucks, right? So once you understand how big that is and how much of a difference it is, instead of just being into a company, you understand the point that he was making. That's a great comment. Yeah, I definitely agree with you, Lucky. Awesome. So yeah, let's jump on in. And I just mentioned, about the reason why I would go with coffee because of the fact that it's a commodity, it's a necessity. But right here we see on the slide where we're asking the question, what is a commodity? Have you heard this word before? Or maybe you haven't, but a commodity is something that is a necessity to the world. It's a need, not a want. It's something that's necessary. Things that are actually consumed and used by people on a daily basis. Not a day goes by 365 days a year we don't use and consume commodities in our daily use. You can just think about from the time you woke up this morning to now, and you'll think about so many commodities that you've already consumed or used from your breakfast or lunch, getting dressed, got in the car, maybe went somewhere, maybe been in the store or online purchasing something. Where we use so many commodities throughout our day, every single day. And as long as people are here on this planet, these commodities are going to always be something that's going to be necessary. Okay? They're going to be something that's going to always be a need. Again, not a want. That's the difference between a commodity. It's a necessity. And one of the things that made me so attracted to this market when I first, was introduced to it, when I learned of the things that traded in this market, I was kind of like the woman I spoke with on Friday, who, she said, I never heard of this market before. And neither had I. Here it is. What we hear about so much is what? Anytime you mention the word trading, what's the first thing people think about? Stocks. But there's a whole nother market that's going on. And it's bigger than you can imagine. That's another thing I want to say while I'm thinking about it. Um, these markets are so big. It's so big, guys. It's bigger than you can possibly imagine how big the market is. And I'm saying that because it came to mind. There's a gentleman that I'm so proud of. I don't even know this guy, but he teaches a course on trading stocks and options on stocks. And he's doing very well with his course. And I mean, he's young, like in the age I was when I got started. And I saw some comments on one of his Facebook ads, and somebody was making the point that when you're selling a course and teaching all these people this strategy and the same, everybody's learning and teaching the same strategy. You know, in other words, the person felt like that you can have competition or maybe mess up the market. And and this is only when we don't understand how big the market is when we think things like this. Once we get into further slides in this lesson, it's going to make sense when you understand how big the markets are and our role that we play in the market. So you you couldn't you couldn't make competition in the market if you wanted to. You couldn't teach enough people to how to get into trading if you wanted to. It only increases or makes the market better. The more people participating in the market, the more and better it is once you understand how the market works. The more traders, the better it is. It's a complete opposite of what the gentleman was saying, you know. And it's just education. We just got to educate ourselves about, what it is and how things work. And this was a good example of people not understanding how this market works. Guys, the more people get involved with this, the better it is for anybody that's in the market. Okay. Liquidity. This is a word we hear all the time. What in the world is this? What is liquidity when it comes to the market? And I want you guys to know that this is what makes the market work. It's huge, it's big, but it's basically what you see here on the screen. Liquidity in the market consists of buyers and sellers entering and exiting the market by exchanging contracts. Point I was just making about the fact that we have more traders in the market, I mean we have more buyers and sellers. What makes the market work is there's always somebody willing to buy what you are willing to sell, and vice versa. There's always someone selling what you are willing to buy. And without that, the market wouldn't work. We have to have someone to buy what we're trying to sell, and we need someone to be selling what we are looking to buy. And liquidity is what that is in the market. And it's something that makes the market work the way it does. So the more liquidity, the better it is for the market. All right. This is what Johnny B shines at, right? He loves to talk about this. Miss you, my friend. So the type of commodity trader, wow, this is something that I want y'all to really pay attention to. We have different types of traders in the market, and everybody plays a different role in the market. But as you can see, we have the commercials, and the commercials, these are the big guys. These are the people who are trading with a lot of contracts, okay? And they also are people who are taking advantage of prices from futures prices so that they can, get the products that they use on a daily basis from a commercial side. And this allows them to take advantage of prices today that's going to be delivered at a later date. And that's what a futures contract is. So knowing that the commercials also participate in this market, just know that they have a different role. Companies like Kellogg's and Nabisco, they use the crops and grains on a bigger scale than you and I. And they need a lot of these crops when they're doing their product and making their product and producing these things. And when they want to take advantage of prices, when they see prices down or trade down or at a lower price, it's an opportunity for them to lock in a price today on a futures contract that's going to be delivered at a later date because they're going to be using these ingredients and these products on a large scale, and they take advantage of that by going through the futures market. So commercials trade in the futures market as well. Then you have another type of trader, which is the producers. Producers take advantage of the market just as well as the commercials do, and they do the same thing. They want to take advantage of catching a price of something at a lower price and then being able to have it delivered at a lower or a later date. And it's important for companies, for the producers and for the commercial to be able to do that because that's a big money. It's big money in producing and growing crops. And if you can get the prices through trading in the futures market, that's a big step for people in that regard. So, what do I mean? For example, um, think of think of someone. Johnny used to talk to us about, you know, an airline that took advantage of jet fuel when it was low, and they was able to acquire a lot of jet fuel when prices were low. Whether they wanted or needed the fuel right now, the point is that they were able to catch the price when it was at a lower price and lock that price in. And that's huge for somebody who may be buying and using fuel on a large scale. So producers and commercials participate in the market just as well as everybody else. Now we have this large speculators. There are two types of speculators. First one I'm gonna talk about is the large speculators. These are guys that are trading in the market, big boys that are trading in the market. They trade with way more contracts than you and I. They trade in a lot of contracts. They have big accounts. They trade in big bulk of contracts. And we're gonna watch a movie here, guys, real soon as homework, and you're gonna get a chance to see an example of what large speculators, how they take advantage of the market. But the large speculators buy way more contracts than we do, and they trade with a lot. I'm talking about thousands and millions of dollars, and all these people trading in the market together. I'm telling you, it all works and makes it work the way it does. But the last one I want to talk about is the small speculator. This is the guy who just opened an account. They want to learn how to trade. They getting in here and they messing around with small amounts of money, and they have, ability to, trade one or two contracts. This is that guy named Delvin Wright, right? This is a small speculator. People just like you and I. But guess what? The most important thing about the small speculators is that the small speculators are the ones that make this market work for the commercials, for the producers, for the large speculators, for everyone. Without these small speculators, the little guys, the market doesn't work with the precision that it has and does. Without them, the market won't work the way it does. Why is that? Because the speculator, person that is just in the market trying to make a profit off the price movement, ends up being the most important because we are the majority. It's more of us in the market than the commercials, than the producers, and the large speculators. There are much more small speculators than the other three. And we make the market work because of that. Remember the slide when we just talked about liquidity? We bring liquidity to the market. If you remember what liquidity was, we bring that to the market. That's why we're the most important out of those four. And that's great to understand because here's what I want y'all to know. I had a conversation with my broker and we was talking about this particular subject. And it was the way he said it to me that really resonated with me. He said, Delvin, away without small speculators, without the speculators trading the market wouldn't work, period. It was it was just basically putting emphasis on how important we are in the market. And he was saying that the market will not work without the speculators. So that's how big we are and important we are to the market. All right. Hmm. So one thing we learn when it comes to financial markets, we know that some of these markets are regulated and some of these markets are not regulated. We have different markets, right? Forex, futures market, stock market, crypto. But the market that we participate in, the futures market, is regulated. This market is regulated, and there's an organization that regulates the futures market, and they are not just regulating the market; it's highly regulated. And that organization is called the Commodities Futures Trading Commission. Commodity Futures Trading Commission, also referred to and known as the CFTC. And as you see on the slide, there's the website. I always try to encourage people, when you get time, just go on their website and look around. Any and everything dealing with the futures market you can find on this website. And it's mind blowing, all the information on the website. But this who regulates the futures market. It's not just solely regulated by the CFTC, but they are the main regulators of the market. So yes, this market is regulated. It's highly regulated by the CFTC. All right.
Hmm.
Trading in the market is fascinating, but everybody don't trade the same way. Everybody has their own way and their own style of what works and what they like for them. There are two types of traders when it comes to trading, and it here's a perfect example. When I was talking with that woman on the phone, you remember me saying that I can tell you from a fundamental side what's going on with eggs. So what that means is someone who's a fundamental trader is somebody who follows the news, somebody who knows the information, um, the blogs, the commentary, the videos, they the gossip, the rumors. That's the person that is a fundamental trader. And then we have a different style of trader called a technical trader. The technical trader is somebody who trades by the charts. They use the charts to make all of their decisions when it comes to trading. That's what you call a technical trader. Then there's what's called some people who are both. Some people trade by the charts and they also use the fundamental news and information reports and things of that nature to help them make their decisions. So somebody can be a fundamental trader, they can be a technical trader, and then they can also be both. All right. So what are the two most popular terms that we hear in the market? What two words do you hear the most when it comes to trading? Whether you watching a business channel or you just happen to watching something on YouTube, but no matter what, if it's related to trading, there's two words you hear more than any of the other words. And I'm sure y'all probably know what it is before we get to the slide, but here's one of them. And the two words are bull and bear. All right. Bull and bear are the two most common used and most common words in the market. So anybody know what a bull look like or a bear look like? You'll get a picture of what that means and how they represent the market. But a bull and bear are the two most common words. So why do I use the word bull and bear? Or why does the market refer to those animals? Because the bull and the bear, the way that they their style helps you to understand the attitude or the attitude or direction of the market. and the bull and bear are two good examples of understanding that. So when it comes to the bull, let's go on to the next slide. When it comes to the bull, I want you to understand that the reason the bull is representing the market trade to the upside is because the way the bull fights. All right. The bull fights in an upward motion. And that's why he's representing the market trading up. And when you hear bull, that's representing the market going to the upside. And the bear fights in a downward motion, swiping and using the palm going down, that paw going down, and it fights in that direction, which is representing the market trading down. That's why the bears represent that, the market being in a downtrend, trading down. Both of these animals are going at it and fighting in the market every day. Um, the bull is trying to take the bear's money, and if you're a bear in the market, the bulls are trying to take the bear's money, the bears are trying to take the bull's money. So whatever way you trade in the market, the other one is trying to take your money. That's what's going on in the market. So the bull and bear are great examples to represent the attitude of how the market is trading. Now, when we get into the market, we can take and have different positions. We talked about this uh, and our rules. And I said that when we get into the lesson, you'll learn more about what we were talking about. But there are some positions we take on when we get into the market. And there's three type of positions we can have when we get into the market. So when we get into a trade and we're trading the market to the upside, that means that bull that we were just talking about. If our order gets filled and we get in the market trading it to the upside, that's what called long the market. That's called long the market. You just got filled on the order and you're trading the market up. Your position is long the market. Write that down. That means you're bullish on the market. You feel the market's going up. You're trading it to the upside. You have a position that just got filled and you're bullish. And now your position means that you are long the market. All right. Another position that we can have in the market is, well, we can trade the market to the downside. You heard me talk about this in the rules. We can be in the market and trade it when the market is going down. That means the market's in a downtrend or we are looking for the market to trade down. So we get filled on a position. That means that we're trading the market down. That position is called short the market. When we're trading the market up, we're long the market. And when we're in a position trading the market down, we're short the market. So remember that. If you're bearish and trading the market to the downside, you're short the market. If you're bullish and trading the market to the upside, you're long the market. All right. But there's also a third position we could take. And you may remember these three, but the third position we can take is being out of the market. Sometimes we looking at the chart and we watching the market and we watch for certain things that form on the charts that we're going to get into when we start looking at charts. But we're watching for certain things, and these things haven't complete or confirmed yet. So what we are doing is still watching, and we're on the sidelines right now. We're still watching, and that's a position as well. We're out of the market, still waiting, being patient. Another one of our rules, waiting for these things to form and take place on the chart. So we are out of the market right now, but we're still watching, looking for a position that we can take. So we have long the market, out of the market, and short the market. Those are 3 positions that we can take. All right. So, Barbara, what is this that we have? Talk to us. What's this slide about?
Yes, sir. So this is about the farmers. We know that we trade, different commodities, corn and wheat and soybeans, but a lot of times we don't understand how it works nor the dynamics of the country. There are particular countries that they produce more corn than any other country, and we import and export, and without that, we would have a problem in our country. And the U.S. happens to be a big producer in the corn. That's why we have corn belt in the heartland because of that. And it is a great supply that goes out throughout the world. Same thing with other countries as we receive grains from them.
So
So
this is referring to a certain part of the country where
yes, it's a
where
certain
a
part.
bulk of corn is being planted, and it's called and referred to as the Corn Belt.
Corn Belt and Heartland. There are certain states in the United States that produces this particular crop, and it's in a certain area, and they've named it this for a reason: Corn Belt and Heartland. So we have a homework assignment for this as well towards the end. But we have a video that we watched that Mr. Johnny likes for us to watch to learn the dynamics of what farmers go through, because it's one reason why we're able to trade. So it's a short video to watch. I'll go ahead and play it.
Hello everyone. Today we are going to the vast cornfields in the states of Indiana and Ohio in the United States to see how farmers here cultivate and harvest millions of tons of corn. The end of April is when most corn farmers in the United States begin the seeding process. This modern agricultural machine is used to sow about 335,000 seeds per acre. Currently, in the United States, there are about 316,000 corn farms, and 95% of them are family owned. According to statistics from 2020, up to 30% of the arable land of the United States is used to grow corn, which is the equivalent of 91 million hectares. The time from sowing to harvesting corn in the United States usually lasts about 115 days. Most of the corn varieties grown here require about 600,000 gallons of water per acre. These planes are used to spray probiotics that help prevent pests and aphids from attacking corn crops. The United States is one of the most modern agricultural countries in the world, so most of the work in the farming process requires very few workers. Nearly 4 months after seeding, most cornfields across the United States are ready to harvest. Giant harvesters will move to the fields to work. In recent years, the United States has always been the world's largest corn producer, with about 350 million tons per year, and accounts for 34% of global corn production. In 2020, the United States exported 69 million tons of corn and earned about $9.2 billion. Currently, China is the largest buyer of US corn, accounting for 31% of corn exports. After harvesting, millions of tons of corn will be transported to warehouses for drying and storage. How do you feel about the process of cultivating and harvesting corn in this video? Let us know what you think in the comments.
All right, that's our video on the Corn Belt and the Heartland. Very interesting to learn what farmers do in the process, the dynamics of what we go through in our country to produce our crops.
Hello.
Guess that's Johnny giving us some entertainment. That's what that is, y'all. All right, Barbara. So
I heard tonight that and I've seen this several times, but I guess because of all the tariffs that we hear in the news, that 31% of our corn goes to China. I heard that tonight loud and clear. I'm like, whoa, that's substantial. Yeah.
yeah, big business, right? Uh, what is this on the screen here, Barbara?
This is our homework assignment. Homework assignment number one. Where is the Corn Belt in the USA? Where is the heartland in the USA? So that's our homework assignment.
All right. Oh, that that slide where we get to talk about these two amazing ladies that do a call every 2 weeks on Thursday. And as you can see, it says if you completed the 10-week course, you want to jump on this call and learn from Dr. Melvin and Barbara. They teach any and everything that we go over on these calls, but they got time to go more into it and have a different format where they can go over stuff that we may not be able to get into on Sunday night call. But every two every 2 weeks they post in the group that they having a call, and I always try to encourage people to jump on that call, take advantage of this call. And I understand, Dr. Melvin, it's not always the second and fourth Thursday, right?
No, sometimes we move it around, but this month it is the second and fourth. And so this Thursday will be our class, but instead of 7 p.m., we're gonna start at 6:30.
Ah,
But we'll put it in the chat, um, the link and everything, so that all those that would like to attend that have completed this 10-week course that we do on Sundays are more than welcome to come and ask questions and dig a little deeper.
nice. Yeah, we appreciate y'all. Very nice. All right. So, any updates or anything you want to share with us, Barbara, about the annual event that we have? Are we, are we updated?
Well, just to reiterate the obvious, everybody needs to be there.
Okay.
You want to be at the Embassy Suites by Hilton Phoenix downtown North. You want to be there April 24th through the 27th. It's something, it's one thing to come on Zoom Sunday nights with us, but it's something different to be live and in person. you're going to get a whole lot of wonderful information that you don't get on this particular call. And we're going to have a phenomenal time there, and we want you guys there. Of course, we got a manual coming out in April as well. You'll have your own manual that you can purchase, flip the pages, and really learn. Some people do better with book, and then they do watching a video. So we want you guys there. We want you to come and learn, start your businesses, continue to grow them, and come and learn from our amazing instructors and mentors that's going to be there to teach you. I promise you, you don't want to miss this. You don't want to miss it.
Man, thank you, Barbara. I can't wait. I can't wait. Sure. I'm I'm already downtown Phoenix waiting on y'all right now. Yeah, just but all right. So yeah, we want to open it up and really hoping everyone receive value from the call tonight and understood some things better, got some clarity on some things that you may not have been clear about. But now let's talk about any questions or comments that you have, regarding what we went over tonight. So the call is open. Anybody got any questions or comments?
Yes, I do.
Okay, Jamal, what you
Um,
got, bro?
all right. So, like, when you were talking about the large spectators and the small spectators, is the small spectators equivalent to having employees in the business, and the large spectators are the equivalent of the owners and the vice presidents of that business? So the the small spectators are very valuable because they are your front men that bring in all of the, like I don't want to say bring in all of the revenue, but I'm saying, like, is that the equivalent to the large and the small spectator? The small spectator is like the employees that do the work, and the president that sits back and, like, receive all of the funds that the employees generate. Am I making sense to you?
Yeah, yeah, you can look at it that way, but just know it's even bigger than you know, even how you looking at it, because whether you have employees or not, or you have a business that doesn't require you to have that many employees, the small speculators, their role when it comes to trading, like I said, it works because of them. Without them, it won't work. And in your in your example, yeah, that you can look at it that way as well. But the small speculators, they have the most important role in the market. Just say it that way.
Okay, and I think I said spectators. I meant to say speculators.
Yeah, it's okay.
Um,
It's okay.
all right, so all right, the corn belt. What I got from that was the corn belt. Is that like a name for a certain thing? The corn belt in Heartland. I know it's our homework, so I'm gonna have to I'm going to research it. But
Yeah,
when that okay, all right, cool, all right.
yeah. It's I think it's a homework lesson Johnny B likes to give out when he finishes this lesson.
Okay, I stay right there with the homework. All right, cool. That's cool.
Yeah,
Thank you, Dave. Check your
great.
messages, bro.
Appreciate that, man. Appreciate
Yes,
the
sir.
question. Good
Yes,
question.
sir. Yes, sir.
So, any more questions or comments on what we talked about with lingo and terminology and um, understanding our role in the market, etc. Things of that. Any questions or comments? Dr. Mel, looks like everybody clear, right?
It looks like they are.
All right.
I still, does everyone understand small speculators and large speculators? Because I know we just had an analogy about the workplace.
Mm-hmm.
I want to make sure that everybody understands. Lucky said yes. Okay. All right. Very good. Very good.
Yeah.
Okay, excellent. Well, as we go along, we will find out if there are any gaps. Yes.
Yeah. Yeah.
You start trading.
Yeah, we get into lesson 3. It's gonna start to pick up with a lot of information, and yeah, it's good that we understanding this stuff that we need to know before we get into a lot of other stuff, right? And like I say, if we don't understand the terminology, it won't, it won't make much sense. But y'all notice every time we had that question about the two most common words, the bull and bear, Johnny B always unmutes and said, "Buy and sell." You know, but we hear buy and sell too. Those are very common too. But yeah, I hope everybody's clear about it, because that what we went over tonight is some important stuff to know, even down to who regulates the market. And again, if you get time, go on that website. It's mind blowing, so much on there.